Have you ever been approved for a business loan, got the funds, put it to work, and still felt stuck? Why did that money come in, but progress not follow? What many small business owners don't realize is that some business loans quietly make your position worse. Here's when a yes from a lender can be worse than a no. Sandra runs a small interior design studio with her partner. They work on residential projects, mostly renovations and full room redesigns. Steady work, repeat clients, and referrals that keep their calendar full. They handle the design and a lot of the work themselves, but bring in various subcontractors as needed. Installers, painters, and tradespeople they've worked with for years. They've been in business a long time. Projects get completed, clients come back, invoices get paid. The studio typically brings in around $40,000 a month in project revenue. Operating costs run about $30,000. On paper, that leaves roughly $10,000 in margin before they pay themselves. It's a solid business, but the timing isn't lining up this month. They are waiting on payments for some completed projects totaling $20,000. Payment terms were agreed to, the invoices have been sent, the clients just haven't paid yet. And in the meantime, expenses don't wait. Installers from the last project need to be paid. Materials for the next project have to be ordered. Retainers for subcontractors are due to lock in schedules. Regular operating costs continue. That outstanding $20,000 doesn't just reduce profit, it disrupts their operating cycle. Without it, they cannot comfortably fund the next wave of work. Just like blood flowing keeps a body functioning, working capital keeps a business moving. When that flow is interrupted, pressure begins to build, creating stress elsewhere in the business. And if your business has ever looked profitable on paper, while in reality cash flow was tight, you may already understand how quickly pressure can build. And when businesses stay under this kind of pressure long enough, the effects can extend far beyond today's cash flow. They can begin shaping the kind of funding the business qualifies for next. Sandra's lack of cash flow could slow future revenue as well. The business is profitable, but profitability doesn't mean liquidity in the bank. When your monthly margin is about $10,000 and $20,000 hasn't arrived yet, the cushion disappears fast. They're not just short on profit, they are short on working capital. Sandra cannot afford to stall active projects while waiting for clients to catch up. In the past, they could tap into their cash reserve, but that's tapped out at the moment. So Sandra starts looking for funding. She's asking for $20,000, not to grow, not to expand, but to stabilize the operating cycle until incoming payments land. She applies and gets a no. She tries again and again. Different lenders, same result. With each passing day, the pressure increases. It's getting harder for her to focus on client work when she's not sure how the next round of expenses will be covered. They need help fast. By the time a yes finally shows up, Sandra and her partner are running out of options. The $20,000 in invoices is still outstanding. Installers still need to be paid. Materials still have to be ordered. The next wave of work still has to keep moving. They've been denied more than once, then finally an approval comes through. The offer is for the full $20,000, but here are the terms. They'll repay $24,000 over the next 6 months, starting almost immediately. That's $4,000 per month, automated repayments of roughly $1,000 per week. The cost is higher than they had hoped. The repayment window is shorter than they would have liked, because whatever data the lending system currently has on their business places it in a higher risk bracket. Their business did not meet the risk tolerance of many lenders. It wasn't being seen as highly reliable in its ability to make scheduled repayments. That's why they heard no after no after no before someone finally offered a yes. This lender was willing to approve them, but only within a tighter loan structure. A structure reflecting the level of approval their business qualified for at that time. Sandra and her partner don't fully realize this. All they could see is that someone finally said yes. And in that moment, that yes felt like relief. Sandra and her partner could breathe again. Accepting that yes meant that they could buy some time, ease a bit of pressure, and keep the business moving. Very often, for businesses in a tight spot like Sandra's, this is the only kind of yes that shows up. A weak one. Stronger yeses never appeared. They couldn't, not for Sandra's business in that moment. They accepted this weak yes because it felt like the best option at the time. But with it came some hidden costs. We'll come back to those hidden costs shortly because they matter more than most business owners realize. But first, you need to understand what a yes from a lender really means. In the lending system, a yes does not mean progress. It does not mean the business is healthy. It does not mean the timing is right. And it does not mean that the system believes in what you are building. A yes simply means the lending system accepted that version of your business at that point in time. Nothing more. Lenders are not making motivational decisions. They are not rewarding a founder's ambition, drive, or effort. They are not investing in the future upside of a business. They are just managing risk. So when a lender says yes, it isn't an endorsement of your business. It's just a sign your business passed a certain risk level. The system is saying, given what we can see right now, this is the kind of yes your business qualifies for. As stated earlier, a yes simply means the system accepted that version of your business at that point in time. Once you understand a yes this way, it stops feeling like a finish line and starts looking like a snapshot. A snapshot of how the lending system reads your business in a given moment. A snapshot that can result in a strong yes, a weak yes, or a flat no. And that snapshot carries consequences. Accepting a yes doesn't just give you money, it creates new information. Information about your business that becomes part of its picture going forward. Which is why not all yeses are equal. Some help a business to move forward, others quietly move a business backward. Even though those yeses feel like relief in the moment. For a business in a tight spot, accepting a weak yes may be the best option at the time. That's understandable, but it comes with hidden costs. I'm Dale, a fellow business owner and entrepreneur, as well as a former high school and university educator. Over the past few years, while working with business owners looking for funding, I've seen the hidden costs small business owners pay when they accept the wrong kind of yes from lenders. Today, I'm going to show you how a weak yes impacts the way a business is seen and treated by the lending system, and why accepting a weak yes is often worse than if the business had been denied. To understand this, we'll examine 5 specific ways a weak yes can quietly damage a business. The hidden cost of a weak yes that is most quickly felt is impact number 1. Instead of expanding breathing room, a weak yes shrinks it. When Sandra and her partner accepted that yes, they believed they were buying flexibility. That $20,000 loan would cover the shortfall, projects would continue, the pressure would ease. And for a moment it did. But that relief came at a cost. Before the funding, their margin was tight, but it was flexible. If a client paid early, the cushion grew. If an expense could be delayed, they delayed it. They had room to adjust. Now, every week, $1,000 leaves their account automatically. Not based on profit, not based on whether a client paid, not based on how the month was going, just deducted. That means out of the roughly $10,000 in monthly margin, $4,000 is no longer available to absorb surprises. Their cushion didn't grow. Instead, it shrank, and it shrank on a schedule. So if another invoice is delayed, or if a project runs over budget, or if a client pushes a payment out another 30 days, there's less room to adapt. What started as delayed revenue has now become a compression issue. They didn't realize it at the time, but that kind of yes doesn't add flexibility. It adds a fixed obligation that reduces flexibility every single week. Here's what most business owners miss. When breathing room shrinks, decision quality shrinks with it. Instead of choosing projects carefully, you take what pays fastest. Instead of negotiating confidently, you accept whatever keeps cash flowing. Instead of planning ahead, you manage withdrawals. That is not expansion. That's contraction. That's the impact a weak yes has on a business. It shrinks the breathing room instead of expanding it. The most far-reaching damage a weak yes can cause is impact number 2. A weak yes trains the system to see your business as riskier. When they accepted that $20,000 loan, Sandra and her partner were not thinking about future lenders. They were thinking about this month. Cover the shortfall, keep projects moving, stabilize the situation. But every funding approval exists within a risk bracket. That bracket reflects how much confidence lenders have in a business. Lower risk inspires broad confidence, which leads to a strong yes. Higher risk results in limited confidence, which leads to a weak yes. The structure of Sandra's approval reflected the level of confidence the system currently had in their business. Not the kind of confidence that unlocks strong terms, but just enough to approve within tighter boundaries. That classification shows up in the numbers, in cash flow movements, in bank statement behavior, in credit reports, in underwriting reviews. And here's what really matters. Lenders don't underwrite explanations, they underwrite patterns. Think about a traffic cam for a moment. It doesn't know that a husband sped through the red light because his pregnant wife was about to give birth. It doesn't record intent, it records movement. Likewise, lenders don't see our client payments were late. They see the numbers. They see the level of capital the business previously qualified for. They see the risk bracket of the business. That determines their confidence level and their decision. Before Sandra and her partner accepted the weak yes, the system had already classified their business at a higher risk level. That's why they got denied again and again before finally being offered that weak yes. The weak yes may have filled a cash flow gap, but it also added new signals to the system. Signals that make their business look riskier than before. If Sandra applies for funding again before this loan is fully repaid, the system doesn't interpret that as temporary pressure. It interprets it as confirmation. Confirmation that the business fits within the same higher risk bracket. A bracket that's easy to fall into and much harder to get out of. A weak yes is never neutral. It doesn't just shrink breathing room, it can train the system to treat your business as higher risk going forward. And that affects what happens next. The hidden cost that cuts the deepest is impact number 3. A weak yes degrades your next yes. 4 months into the 6-month repayment schedule, Sandra and her partner have made every payment on time. It's now mid-August. Renovation requests are pouring in before the holiday season. Larger contracts, bigger material deposits, more projects running at once. The business isn't struggling, it's expanding. To take full advantage of this seasonal boost, they need additional capital. They're going to apply for funding again, and this time they feel different. They've already been approved once, they've been disciplined with repayments, they've proven that they can handle the obligation. They believe that this time they should qualify for more yeses, better yeses with better terms. But here's what they don't realize. Every funding decision is based on a snapshot of how the lending system reads your business at that moment. A snapshot built from the data the system can actually see. And the unfortunate reality is that much of the good behavior business owners assume the system is tracking doesn't reliably show up. According to the SBA, out of more than 500,000 suppliers who extend credit to businesses, only about 10,000 actually report to business credit agencies. That's roughly 2%. And some creditors only report serious delinquencies, not consistent on-time performance, which means a lot of on-time repayment behavior never becomes visible in the places lenders commonly check. So while Sandra feels that their business is proving reliability, the system may not be recording such improvement. What it is recording is the recent tier she qualified for, that weak yes. When they apply again, the system takes another snapshot, and that new snapshot includes a recent higher risk approval, elevated repayment exposure, tighter liquidity, and a reinforced higher risk classification. The system no longer sees the same business it saw before that week yes. Even if their revenue is stronger now, even if clients' payments have been perfect, the system does not automatically see that context. It sees what is reported, what is pulled, and what shows up in the financial footprints it relies on. Their previous snapshot read higher risk. That created limited confidence and led to a weak yes. Their new snapshot has additional higher risk signals from that weak yes. And that's where quiet degradation happens. Sandra and her partner expected broader confidence and better yeses. Instead, they were offered similar terms on slightly smaller exposure or pricing that still reflects the same risk tier. They expected $30,000 with longer terms. Instead, the best offer was $18,000 on terms almost identical to their current loan. A weak yes doesn't just reflect your tier, it influences the next snapshot, and that snapshot shapes your next yes. The most deceptive of the 5 ways a weak yes quietly damages a business is impact number 4. A weak yes creates the illusion of progress. When Sandra and her partner received that first approval, something shifted, not just in their bank account, but also in their mindset. After hearing multiple no's, someone had finally said yes. That showed that their business was fundable. A lender approved their request and transferred funds into their account. That felt like progress. It felt like validation. It felt like they had crossed an invisible line. But here's what most business owners don't realize. Fundability, like creditworthiness, exists on a scale. Just like a person or business can have poor credit, fair credit, good credit, or excellent credit, a business's fundability can range from low to high, from minimally fundable to broadly fundable. So yes, Sandra's business was fundable, but its fundability was on the lower end of the scale. That's why their approvals came with tighter terms. To Sandra and her partner, that move from denied to approved felt like an upgrade. Their business wasn't unfundable anymore. And when they got multiple offers the second time around, it reinforced that belief. They thought, at least we can get funding. At least lenders are saying yes now. Next time will probably be better. That's how the illusion of progress begins to take root. Approval feels like upward movement, but approval within the same risk bracket is not the same thing as moving up the ladder. The fundability level of their business didn't suddenly get better. They simply became more confident that funding was available. Those are not the same thing. And when that distinction gets blurred, urgency fades. You become less focused on why strong yeses aren't showing up. You stop asking what is needed to change your risk bracket. You adjust your plans around what you can access instead of working to expand what you qualify for. That's the cost of the illusion of progress. Weak yeses can make you believe your fundability improved, when in reality you are still sitting on the same rung of the ladder. A weak yes doesn't just influence how the system sees you, it can influence how you see your position in the system. And that perception can delay the work required to move up the fundability ladder. The biggest hidden cost of a weak yes is impact number 5. A weak yes can lock you into a cycle of weak yeses. When a business repeatedly qualifies within a higher risk bracket, something subtle begins to happen. That bracket stops feeling temporary, it starts feeling normal. Sandra and her partner didn't count on being offered only weak yeses. They expected their next yeses to be stronger. Instead, those yeses felt familiar. Similar limits, similar structure, similar constraints. Not because they were irresponsible, not because their business wasn't growing, but because nothing had fundamentally changed about how the system classified them. So the pattern repeated. Another weak yes, followed by reduced cash flow flexibility, followed by another application within the same bracket. Over time, that bracket becomes your operating environment. You start planning around it, timing projects around it, structuring growth around what that approval level allows. Not because you want to stay there, but because you begin to accept that's where you belong. And when that happens, the cycle locks in. Each weak yes solves immediate pressure while sending additional higher risk signals to the system. This gets added to the system snapshot of the business, influencing the next yes. Until that snapshot improves, the next yes is likely to be more of the same. In addition to training the system to see your business as riskier, a weak yes can lock you into a cycle of weak yeses. After seeing what a weak yes can do, the obvious question becomes, how could a no possibly be better? Getting a no is no fun. A no feels discouraging, a no feels like rejection, a no feels like the system slamming the door in your face. But a no doesn't add new risk signals. A no doesn't create new repayment pressure. A no doesn't reinforce a higher risk bracket. A no preserves your snapshot. It doesn't change how the system currently classifies you. When Sandra and her partner were denied, nothing about their business changed. The system didn't downgrade them. It didn't tighten their classification. It didn't compress their margin. It simply said, not yet, not with your current risk profile. That's just information. And information, even uncomfortable information, is safer than a weak yes that reshapes how the system reads you. A denial leaves room to improve. A weak yes can reduce that room. A denial pauses movement. A weak yes can steer it in the wrong direction. That's why a weak yes is often worse than a no. But accepting a weak yes may be what you need to do given your options in the moment. And that's okay. I understand. I've been there too. But here's why things are different for you. Now you know that a yes is simply a snapshot of how the lending system sees your business at a point in time. That there are different types of yeses. That a weak yes reflects limited confidence from lenders, and that lenders' confidence is based on risk signals created by the information the system has about your business. This is where your power resides. You have the power to change the information the system sees, to elevate lenders' confidence in your business, to move up the fundability ladder, to qualify for strong yeses. Because stronger yeses don't just mean better funding, they can mean less pressure, better timing, and more control over how your business grows. And if a yes is a snapshot, then a stronger yes begins by improving your next snapshot. You can get better funding with better rates and terms. You just need to know how. And that's exactly what I'll show you in our free training. Click the video on screen now to take control of how the lending system sees your business. See you on the other side.